Alright, hello everyone, welcome to the Fenbushi DeFi Salon. Some of you guys were here at the brunch already. Thank you so much for the support. So I'm just gonna quickly start out with a very quick intro. Oh, I guess I don't have to use them, right? I mean, that's fine. Alright, my name is Chloe. So I'm the portfolio manager and also PR director here at Fenbushi, and then this is Turan.
Yeah, I'm Turan, leading the research team at Fenbushi and also doing my PhD in cryptography.
Yeah, perfect. So, a very quick intro on Fenbushi. So we're actually one of the earliest and also the oldest venture capital firm founded back in Asia, focused in blockchain investment since 2015. And then we have over 300 plus portfolio companies, and some are like pretty well known as in Ethereum, Circle, Consensus, Filecoin, Polkadot, Affinity, Flashbots, etc. Like 300 of them. And the very fun fact about us that I always say as a PR line is I don't think you guys know, but we're actually the earliest investors to Ethereum. I know a lot of people say them out there, but why are we the earliest? So when Vitalik had the idea of Ethereum, he actually came to our founder, and then our founder brought him to China to start doing the roadshows and everything. So that's how we started with literally like the whole ecosystem and also the venture capital as well. So we are literally very, very early on for the whole blockchain space. So yeah, that's just the PR that I love to say because I think it's just very eye-catching. And so we also are investing across different verticals. So we literally ranges from like everything. And the majority of the investment teams are here today. And I'm just gonna do a very quick intro as well. So we have Kobe in the very back. So he's the investment director that does all the AI deep in data vertical. And then we also have Clarence that does the whole GameFi NFT and also consumer track. And also we have Tony that does the general DeFi infrastructure. And then we also have Deke that does the whole RWA stablecoin and also a US licensed lawyer. And then he's gonna be presenting something very fun, I'm gonna talk about it. And then we also have Turan that he did the intro, very cool, he's doing PhD at UCLA in cryptography. Yes. Yeah. So this is pretty much the majority of the team here, and then we're gonna be presenting you guys with the whole like DeFi Salon. So I'm also just gonna quickly pass it to Turan to talk about our flagship event, which is the Fenbushi Research House. So he's gonna talk about it.
Sure. We'll get this on. Nice. Yeah, thanks for the intro. So, like we said, we have every year a flagship event, usually at one of the biggest Ethereum events of the year. It's called our Research House. We've had two very successful ones, one in Istanbul, the other in Bangkok. We have usually lovely mansions with everything you could possibly want, with a bunch of people coming over. Some notable people that have also stayed in the Research House being the physicists behind Halo and Halo 2. We had what else? Alumni from A16Z Crypto, a professor from NYU, and some of the most, in general, interesting people in the DeFi stablecoin everything space. So come build, jam, riff, anything like that, and follow us, most importantly, on Twitter at Fenbushi. If you don't know how to spell it, it's right up there, just at Fenbushi. We'll be releasing the applications and everything in the coming weeks or month online, and you can see it up there. Thank you.
And also just to add on how cool the whole Fenbushi Research House is, we have private chefs that we've done, we have like accommodations provided, we have chauffeurs, like literally everything. It's like a very nice resort villa for everyone that are interested, but we'll be purely researching, also doing workshops, no parties, but we sometimes do like parties as well. So depending on the vibe of the event. So I'm also gonna quickly start out with just the agenda of today. So we're gonna the topics will be ranging from different aspects of DeFi, from AI to RWA, and we're also gonna be hosting a very, very fun interactive crash course on crypto law, which is stated right here. And then, so for the AI panel, we're featuring speakers from co-founder of Biconomy, founder of Lagrange, solutions architect at EigenLayer, and also VP partnerships at Flock.io. And then we're gonna move into the interactive crash course on what's already happening in crypto law today, hosted by Deke, investment director and also US registered lawyer. The session will cover literally everything from US regulation framework, policy updates, things you hear about, for example, Genius Act, Clarity Act. So no legal background is needed. so whether you're like building, investing, or just curious, this crash course will be the place for you. I'm trying to make it very interesting because it is going to be very interesting. So don't be scared because it's crypto law or whatever. So it will definitely be impactful for all of you guys to also just get the knowledge on what it is, and also it will, because crypto law affects us literally daily, like on a daily basis, even on like personal investment level. So I'm pretty sure that you wanna come and listen this. So we'll promise you that you'll walk away like a pro. So lastly, we're gonna close off with the RWA panel featuring speakers from Ondo, Morpho, Huma, and Plume. And then we're gonna have the networking afternoon, and then the event will close at 6 p.m. So we truly hope that you get the most out of this. So please network and also learn as much as possible, and also get connected with the whole team. We will have a coffee and everything in the back of the room, but please be relatively quiet when you're in this room to respect for the panelists and also presentations. Well, thank you guys so much. We're gonna get started with the panels. Perfect.
Perfect. So before we kick off the panel, Chloe coincidentally had on the registration form, mom, or rather, how do you explain DeFi to your mom? Coincidentally, my mom is in the back, so if you want to. So this wound up being a very, very fortuitous question. So some of the best, either funniest or self-deprecating responses we'll go through. The first one was just, Mom, I work for the internet, period. Mom, I work for the internet. Next one was, it's like an ice cream DeFi is like an ice cream under the sun, except the ice cream is your money. One nice one was the one-click magic money button, followed by, or you get hacked. Same vein, magic money appear and maybe disappear. And I believe the last one, which was actually, if anyone needs a slogan, capital with no curfew. So those are some of the best ones that we got. If you have more, or if you want to explain it to my mom, you're welcome to. And with that, I think we can bring up the panelists for our AI and DeFi panel. So if you all want to come on up, 1, 2, 3. Cool, so DeFi's been around for a while, and the biggest thing recently has been AI in everything. We've heard of, blockchain and AI for everything now with on-chain agents. I think we've had more meaningful activity in the space than ever before. So I think what we can do to get kicked off is I'll pass the mic around. We can all introduce ourselves and also say why we're on the panel. Yeah? So first, Ismael.
Thank you so much. So my name is Ismael. I'm the co-founder of a company called Lagrange Labs. We focus on the intersection of AI and zero-knowledge proofs. So put very simply, we are able to add cryptographic guarantees on top of the use of AI models and security-conscious settings, which are things in crypto like agents and decentralized training, decentralized inference, etc. And outside of crypto, it's everything from aerospace defense to healthcare to enterprise AI.
Hey everyone, my name is Ahmed. I'm one of the co-founders at Biconomy. We essentially provide orchestration and transaction infrastructure, and of course, agents these days are actually doing stuff on chain, and we essentially are providing transaction orchestration infrastructure to agents.
Beautiful. Thank you for having us. My name is Wes. I'm a member of the DevRel team at EigenLayer. And been in this space for quite a while. So 2013, 2014, I was working in machine learning for enterprise space, back before they called it AI, and had a lot of fun there. They went to Google Cloud for a while. I thought like this deep learning AI thing was going to be big, but it was a little bit early. It was deep learning at the time. It was not GPT, so it was kind of it was a rough go. In the evening, I was mining Ethereum as a solo miner. So for about the past 5 years, I've been able to work on decentralized compute systems and also AI as one of our primary use cases. So this is like the best of the both worlds for me, and I'm excited about the topic with you guys.
Hi, I'm Vatsal. I work with Flock. We do infrastructure for distributed training, specifically federated learning, which is like with legacy AI. Why am I here? I think my co-founder is running late. So
Yeah, we'll just pass this around, it'll be easy. Yeah, so to get things kicked off, agents are clearly here, GPT is clearly here, but we've had AI and blockchain as an intersection for a good while. So I think a good thing to kick it off is what's still sci-fi, what's actually here, and then what progress has been made coming up, right? What have we broken down the past couple of years? Where are we at now? And then what's coming up in y'all's broader roadmaps for AI and integration in the space?
Yeah, so we saw an explosion late last year in kind of this whole AI agent meta in crypto, right? There's a bunch of virtuals and Twitter bots that people got really, really excited about, and they did very well. People made money on them. But I would say 99% of what people are building in crypto right now with AI is vaporware. There's like very little agents that people actually are developing at any meaningful usage. And that's partly a product of the fact that it's this very nascent technology in the space, and also partly because like most things in crypto have much more infrastructure than they have actual on-chain usage. And so a lot of the AI technology in crypto now is kind of like a solution looking for a problem. Like, oh, we're gonna have a future where there's 4 billion trading bots on chain, or like everything's gonna have an agent that these agents can't have bank accounts, so they need to bank on chain. But most of this stuff is like kind of vaporware right now. I think there's some very select use cases where crypto technology is actually very beneficial for AI. One of those would be sourcing cheap compute. Another one would be getting around, I guess, I hate to say it, but it would be getting around laws surrounding who can access GPUs. So it's like regulatory arbitrage for GPU access. But beyond that, there's not a ton that people are building that's really valuable.
Yeah, I'd like to agree with Ismael here because when the whole AI agent meta was booming, it was like, all right, we've got some pretty cool stuff. Let's see what we could do with AI. And it was like, a lot of it was vaporware. And I would say this quarter, that has somewhat shifted just a bit. We're working with a couple of projects where they need transaction infrastructure because the agents are actually doing like transactions, right, based off user input. So, and of course, this is, I would say, a bit more specific on the crypto side where the apps are basically working, they're basically providing a way for users to just use on-chain easily by accessing different chains, acquiring different tokens, potentially even like creating smart contracts very, very easily. So I'd say like right now we're like for example, Wayfinder AI or Ask Gina are like some apps we work with where you literally tell it a prompt and it will do it for you without having to think about gas, having to think about bridges or anything like that. It just works under the hood in one signature. So it's starting to shape up but that's on the transaction side. But on the other side as well, I would say those there was this one case that we're seeing is that a lot of users just love to query these specific AI agents for just on-chain analysis of what's happening in the market. So they might not use these agents to execute, but they're just using free credits from these startups to say, hey, what's happening on-chain? And there's actually like valid information. So at least that's what we're seeing so far.
No, I agree with both of you guys. It's interesting, to your point, what do we have, what is reality? Well, it's actually nice to reflect that at least we do have decentralized inference options now, which we didn't have in the past. Like we have networks for some decentralized training, folks like Jensen and others are in that space. Folks like Gaia are focusing on inference and the hardware around that. We have excellent partners like Lagrange that are doing a lot of great innovation in the ZK provable side machine learning, which is fantastic. There's tons of innovation there. So we do have some very real meaningful tech, which, like years ago, this was seen as like an important component to prevent us from OpenAI taking over the world. When they had the first GPT and it wasn't clear if other companies were going to have a competitive GPT, they thought, well, we need some decentralized alternatives, So it's good for society, it's progress, but also it seems like the meaning of the term agent has evolved over time. In the past, it might be like a conversational bot you're having, it's like, is that an agent or having an agentic conversation? then it might mean like, social media interaction, or it might mean like DeFi interaction. I think that's all fine and good. People are trying to like use words to wrap this functionality in a simple way. Whereas, I mean, even in Web 2, if you go to Web 2 and you interact with like GPT or Anthropic, it has agentic capabilities like Claude Code on the back end is spawning workers to do various tasks for you. So I think our terminology is going to continue to evolve. I think one thing that will be interesting though is, there's a theme right now that there will be perhaps many agents in the future. The only thing that opinion I have that might be somewhat contradictory would be that, when I interact with GPT and I give it access to Google Docs or other systems that I use, man, it becomes like very easy to use and very friendly. And like, I hate to say it, but some number of users will just rely on those centralized services. So I'm looking forward to seeing how Web3 comes up with good alternatives to those things.
Yeah, I think I agree with a lot of the take that now I think decentralized gaming is doing extremely well. So we just had data parallelism till now. I think there are projects like so I have the Bitcoin model parallelism where you just have GPUs taking over each activations or each nodes, and you don't even have to load the entire model, just load a single layer. So it's definitely interesting work going on out there. I think a lot of focus in Web3 now is with privacy, which is sort of interesting because Microsoft just released a paper yesterday which beat a lot of top physicians in diagnosing diseases. So with that still is an ensemble of models, costs tens of thousands of dollars to reach an 80% accuracy. That is still something that we're yet to see for privacy preserving in private. So yeah, fingers crossed for that.
Yeah, which by the way, if y'all want to respond directly to someone's comment or answer, please by all means do. I like two things that we touched on specifically, like Ismael, you kicked it off specifically with, what is it, the fact that a lot of it's, both of y'all said a lot of it's vaporware. So like, I think the natural question to that is, what do you want to see people build? Is it like more interesting agents, or you also brought up the fact like, hey, there's a lot of infrastructure that we need to build to even like get to interesting applications in the first place. And then I think taking it one more further, for example, Wes, you said, and then we also mentioned the privacy at the end. Especially with decentralized AI, we have our current more or less vertical model of like, okay, we have a centralized ChatGPT, it gets trained, it gets put in front of users, and then users use it. So are we just spreading this across several nodes? Are we just like breaking it up to be one line with one stack of hardware of user, or are we like, does it look anything more interesting than just taking that and making it decentralized? So I talked a lot. Pick out any of the things that I'd like to hear y'all's response.
Yeah, so I'll start by saying, I think there's a commonality in crypto to try to sell decentralization as a product. In reality, decentralization is just a software architecture, right? You're going to provide a consensus on top of a distributed system, and then all of a sudden now it's centralized and fault tolerant. So the thing that you are selling as a product is censorship resistance and liveness and safety in the fact that you have replicated execution across a consensus set. So the way that you should think through a product that uses any type of decentralized AI is, where does there exist a real problem in some sector that has users and revenue that people are willing to pay a premium for any of the three things I mentioned: censorship resistance, liveness, or safety. And then you should ask, okay, well, is decentralization the right technology to address the willingness of a customer to pay for one of those three properties? And so in the case of what we do, right, we generate zero-knowledge proofs of AI. The comp I like to give is the entire internet is secured by TLS on top of HTTP. We provide ZK on top of machine learning as a way to authenticate the accuracy of models being used in security critical systems, both within crypto and outside of crypto. Hence, we work with companies like NVIDIA, Intel. We work with a very large hospital system, or several very large hospital systems. We work with people in aerospace and defense, where there's like a real demand for using safety and privacy on top of existing machine learning deployments. So the question I would say for any application in crypto is just, is there a willingness to pay for what your embodiment of the architecture of the technology actually offers? And so for decentralized training, well, if you're in a country that has sanctions and you want to access compute, well, you're willing to pay a premium for censorship resistance so that you are not going to be censored by the sanctions, right? That's a market, not a market you probably should say you're going after, but that is a market that exists, right? If you're saying, okay, well, this trading chatbot really needs to be decentralized, my question would be, where are people using the centralized trading chatbot that have an issue with the security of it? And that's the thing stopping them from putting more assets into it. And most people don't have an answer because there isn't a successful deployment of a centralized trading chatbot, right? So like most of these things don't have a low security deployment that people are using. So it's very hard to sell a high security deployment if you just can't substantiate the existence of the market to begin with.
Yeah, I think the topic of it is decentralization important. It's a separate one. I think I've had this conversation about 2 or 3 times in the past couple of days in Cannes, because at least from what we've seen is, even in crypto itself, right, people are okay with and dealing with centralized products and protocols. Anyhow, I don't think that's the topic coming in today. But to answer your question, about sort of the vaporware and do we kind of need a bit more infra before we get the apps? Honestly, I'm now more in the bucket of the more apps there are, the easier it is to identify what type of infra is actually needed, because you're also going to get these applications building out the infrastructure themselves possibly. And so at least with sort of the applications that we're working with, we're learning quite a bit about sort of what they need, especially when it comes on the transaction side. The way I like to see it is that we don't need to build more infrastructure, we just need to build more apps. Get users to actually use this combination of crypto and AI together. Because there is a willingness, as long as the product is good. And once one of these have escape velocity, there'll be a lot of copycats follow, as we've seen naturally. And so yeah, the more apps, the better. Infrastructure will always follow.
Yeah, I think to your second point around data privacy, that's a very interesting space, because there have been so many good technologies in that space to try to solve it, whether it's fully homomorphic encryption, zero-knowledge proving, trusted execution environments, different mechanisms, folks like lit protocol, splitting keys amongst various semi-trusted providers. There's been a lot of work and effort in that space, but as a builder, it doesn't feel like it's fully solved yet. If I want to have my own personal private data, make it easy to use, maybe upload IPFS or something, to still keep it private, such that when it's operated on, it's not totally accessible or totally can be confiscated by the operator. So I think that's a good area to for folks to, companies to invest in and solutions to be built out. Because if you have that, then you have a common medium. Otherwise, I think the average developer will probably prefer centralized cloud until we provide some better solutions for builders in that space.
Yeah, I think someone pointed out that there's a lot of scope in figuring out the regulations arbitrage. Just to add another thing, I think someone who just figures out government regulations and builds a large-scale model to solve a specific thing across, for example, a network of hospitals, given the kind of data that they have and the kind of data access that they can get to, I think it's win a lot, and I think we'll have a much better healthcare models and other models. Yeah, I'd love to come up with that.
I just want to respond to something. I think one of the problems with crypto AI broadly and just crypto infra broadly is that we're in this period where people just think it's somehow noble to build stuff instead of selling stuff. You shouldn't be writing any code or building anything before you have customers lined up to pay you for it. Otherwise, you're just burning OpEx for no reason. And so 99% of the things people are building with crypto infra has no market that's identifiable today. And they're just hoping that they're going to build it and somehow a market's going to mature and develop. But if you go okay, who has signed a contract to pay you $3 million if you spend $1.5 million building this for the next 18 months? And they look at you deer in the headlights. I mean, it just isn't a logical way of constructing a business. It's just because we have multiples on infra and token markets that are able to sustain bad investing practices. The majority of investors don't ask these questions because they can make money if this thing's launched a token with no customers and they hedge on perps and it goes to zero.
Yeah. You're totally right.
Wes, do you want to respond?
Yeah.
Please.
Yeah, I mean, I do agree. My point was just forget the token, but I just build a LM model or something with that kind of data. I think when you're sort of trying to build a segment out of nothing, you may not have the market very ready right now.
No, you should always build, you should not build a single thing that's not a market. I mean,
It's a very nuanced point, and so like having spent time in enterprise sales, where like at the end of every quarter, it's like how much revenue you bring in. It's exactly that perspective, and I think especially in terms like like Lagrange is a good example of building a thriving business. Like having that perspective is invaluable. I mean that's exactly the right type of model for building a business. And so on the one hand, I agree with you 100%. On the other hand, I look at projects like Bitcoin and Ethereum, and it's like, I don't even know how you would monetize that kind of a pitch, but maybe over a longer period of time, if you have a strong community of folks, I mean, well, it does. It had a very small market. Yeah.
I mean,
Well, that's
now
true.
it makes sense. Like, no, I'm saying now the Bitcoin market makes sense. It will not make back.
But to your point, it's like,
cross-border remittance has been hundreds of millions of dollars, billions of dollars. Like there's a market that exists.
Yeah.
Sorry.
no, you're right. I mean, but when you first start Bitcoin, it's like up to you guys, on a forum, and it's like, okay, we're all passionate about this thing. So like, if you're going to like an investor and you're like, hey, like we're all really passionate about data privacy for AI, there's 5 of us on a forum, that would be a difficult pitch for a VC. But my point is like, not that you're wrong in your way of thinking about it. It's like maybe I just like have like an emotional like believer sense where it's like I want to believe these projects can build out meaningful tech over the long term. But I wouldn't invest necessarily that way either with my own bags.
I mean, maybe it's a softball question, but it also has to be asked, like, coming from VC, and the whole point of part of deep tech is, like, the market doesn't exist. Like we said, hey, we have a lot of AI infrastructure. We're building all these, like, decentralized prover networks. Who the hell is proving anything, like, actually useful or doing anything useful user agents? So is it the differentiation that, like, hey, don't build it unless you're, like, certain that the market's going to be there, or just, like, market's not there, don't build, and let some other idiot waste their money and do what's actually useful?
Yeah, so I think there's a big difference between building deep tech, which is technology that requires substantial R&D and OpEx spending before you can capture the market, and building tech that doesn't have a market, right? Those are two very different things. So like building robotics to automate manufacturing, that's deep tech, right? If you want to automate, I don't know, drug discovery, that's deep tech, but there's a market, right? There is a market for drug discovery that's not automated with robots. There's a market for long distance trucking that's not automated with robots, right? There's a market for large scale manufacturing that's not automated with robots. If you're gonna spend $100 million on R&D in 10 years trying to automate it, you're going towards something, right? You wanna talk about fission, right? It's a massive market for cheap energy. Right? There's no limit. It's arguably the basis of modern societies is affordable energy. And so, yes, there's a market for that, right? You want to talk about AI. You say, what's the market knowledge work, right? What's the human GDP for knowledge work? About like 100 trillion annually? About? So, okay, well, that's the market you're going for. But like, there is a market. It's not just like, well, I think people care about privacy and I think people care about liveness, so we're going to build this thing and then like hope that they're going to want to pay for it. Like, if you said I have a robot that's going to automate manufacturing, you could go out and sell that today. You could go out and sell a lot of this deep tech today if it was built. And so you're spending R&D cycles on something and a lot of money on something with the knowledge that when it's complete, there exists customers for it. It's very different. If you said, okay, I have a decentralized training platform that's fully private. It's built today, it's production, it's ready. Who's going to pay for it? Like, do you have a customer? Is Google going to come and give you $100 million a year? I don't think so. It's going to be a tough sale. It's going to take you years to convince customers and lobby people and get people to actually want to spend on that. There might be a small market, but I would argue not large enough to justify the OpEx for it.
Yeah, I mean, just as an example, we're planning on decentralizing our orchestration platform this year. I don't think it's gonna happen. Nobody cares, right? We have a permission network, 8 node operators. It's probably more decentralized than any L2 because all these L2s have one sequencer. But anyhow, we're like for us, what would get more market, for example, is adding Solana or providing all these newer functionalities or newer chains because they would either be on market or users. So this kind of goes back to the earlier point of I don't know if it's fortunate or unfortunate that we're not caring about decentralization. I think it's just maybe because crypto has now gone into the it's maturing, right? Like now we're seeing a huge crossover between be it on the finance side, between the real world and crypto that people just want something that works before we get to this sort of utopian decentralized world. But yeah, I just think this is just how things currently stand. Things might change in a couple months as it does. But yeah, I think we kind of derailed off the topic, but I think this is interesting regardless.
Cool. I mean, it's neat because everything also like actually goes in pretty well to the next stuff, but also like, okay, cool, we're at a crypto conference and we went over the whole like, okay, idealism a little bit, but like bring it down to reality, especially what a couple years back, it was everyone was doing their own like L1 or whatever, and it got to the like very valid point, who cares? Like it just doesn't matter. But yeah, the next thing we wanted to do was safety also, which I think is also like, everyone can debate AI safety. It's not really interesting. On the other hand, let's frame it in like either the market standpoint or what does it mean for also DeFi. It's one thing to talk about privacy. It's another thing to actually be like, hey, what are the AI safety things that you should talk about? And yeah, it's actually like being an actor agent on markets, being if it's being a custodian you use your funds, or if we're doing regulatory stuff, or again, does it make sense to have some kind of new framework or anything like that?
Yeah, so I think there are places that exist in AI where people are willing to pay for safety over the execution of the model and privacy. So like I mentioned aerospace and defense earlier, right? So think of an autonomous system that has the agency to execute a kill chain, right? So a drone that has some type of weapon that's associated with it, okay? And so would you pay more to ensure correctness of execution of the model, making a life and death decision in the drone? The answer is unambiguously yes, you would. Okay, so there exists at least one place that we can talk about that people do, and you can think of other applications as well, right? If you were a hospital, for example, which is a great use case, right? There are data privacy laws in the US, and in many other places you're forced to comply with HIPAA, for example, in the US. And you're unable to share weights of diagnostic models between hospitals if you fine-tune them. You just can't do that. So would you pay a premium to allow a children's hospital in Texas to be able to access the diagnostic capacity of a children's hospital in Boston? The answer is yes, you would pay a premium because it's whatever the difference in the performance of those two diagnostic models are would be the marginal value created through the use of privacy over the model that enables the weights to be used by the other hospital. So there are use cases that exist in this stuff that you can, in fact, sell to. And DeFi, I think, is a natural use case where, would you pay more to stop your assets from being robbed? Like, I think one of the things people forget is that, like, a lot of the renaissance in bridge design that we saw 2 years ago, where we kind of just went from really just trust me commercial bridges to like the layer 0 popularity, the Axeler, or the Polymer, or there's a bunch of bridges now, right? All the ZK bridges. It came on the back of DeFi hacks, or bridge hacks. Right, so the Harmony bridge hack, the Ronin bridge hack, and all of a sudden, people were very, very concerned about the security of their assets that were bridged, right? And then now you talk about, okay, well, why should ZK rollups exist? It piggybacks on the same concept, right? You moved your assets to Harmony, and the Harmony bridge just pulled out from under you. You moved your assets to Ronin, and the Ronin bridge pulled out from under you. Now, all of a sudden, you're willing to pay a premium on the value of the transaction on L2 if you can ensure that your assets won't be pulled out. That hence you can sing, it's Darkware, and where the market for those kind of came from. And so it's the same thing with AI, right? I would like to frankly see a usage of AI in DeFi before we start talking about like secure AI in DeFi, right? But once we have usage of AI in DeFi, there will eventually be some type of, hopefully not very large compromise of assets. And then we can start talking about the premium one would pay for more security conscious deployment of AI within DeFi.
Yeah, I'll give specific examples on this. So we're working with a couple of projects. One of them is called Ask Gina, the other is called Wayfinder AI. They're both integrated by Biconomy, but they have different ways of the security aspect, right? So what do I mean by that? With Ask Gina, so let's ask with Wayfinder AI. With Wayfinder AI, you basically say, I want to do this. Super transaction happens. Well, before the super transaction is signed and executed, Wayfinder specifically asks the user, hey, sign the transaction by turnkey. Like you have to actually press the button, right? And then the user signs and it goes. With the Ask Gina, literally tell it a prompt, the transaction will happen. You can't even stop it midway, right? Mm-hmm. Now, from a user perspective, I like the latter. I like Ask Gina. It's quick. It just does everything. I only got rugged once because instead of virtual, it used virtuals, and I bought some random shitcoin somewhere. But that was the only time I probably lost $15 because it just lost me. It picked the wrong coin, and so in that model, it's like very I'm still unclear what the user behavior will look like in the future as well, because some will say that hey, I actually want to physically sign something before executing versus letting the AI just autonomously sort of go about executing. And of course, I think a lot of people have a vision for just autonomous, execution and stuff like that. So, yeah, I'm not sure if people right now are willing to pay for that extra security or even want that, that experience of having to even just, add an extra click or something like that. They just want things to happen very quickly, right? And this is more, this is on the borderline of DeFi, I would say. This is just on, hey, move between chains, swapping different things. There will be use cases, and we're seeing already being built out, just looping strategy of yield, right? And that's something I think we're going to get to, and we're going to see, something in production phase soon, to be honest, because that's something people want. And yeah, so I definitely feel, especially when it comes to DeFi, we're going to see more use case specific applications from the security sensitive.
It's interesting to use the term safety. I think maybe most of the non-crypto crowd would think of safety in terms of there's some AI, there's an LLM, it was trained based on certain expectations, cultural expectations, political expectations, what's appropriate, what's not, what the LLM can do, what it can't do, so we don't want it to escape, maybe, and run on its own, things like that. So Anthropic's very interested in safety is one example. They invest heavily in introspection of the models. Why is it coming up with a result? But others don't care about that. They want to have more open-ended. There's a market for very open-ended LLMs and not filtered in any sense. But in regards to DeFi, I think as a DeFi user, I think I'm more interested in almost the term control over the LLM, or EigenLayer will use the term verifiability, and there's many important techniques. Zero knowledge proofs are an excellent technique, such that the LLM behaves exactly as I want to. So that when it trades exactly as I want to. And even the worst case scenario is you inherit some model from Meta, like Llama or something that's very popular, and you say, go trade the Twitter or X private tokens, and because it's Facebook, it doesn't like, and it trades the wrong token for you, whatever reason. So then it really becomes an interesting question of, if I want to have control over the AI, do I need to be involved in both the training of the AI and also the inference of the AI? How much control do I have at different points in the ecosystem, such that it behaves the way I want it to? And I think there's a lot of good platforms in the space that are trying to build out those solutions. So maybe it's a combination of those technologies so that I have complete control and let it run, but it's doing what I want it to do.
I think you touched on a very interesting point of model safety, because the underlying model becomes super important, and there is enough research being done to show that your agents could be, your models could be like sleeper agents, wherein they would act normally except in a very, very, very specific area. For example, you just want to destroy X government records, only in that case. And then there's good enough credible peer-reviewed research around it. So probably that's also an important area where you might want to start from model training. Because a lot of these models, while being open source, are not truly open source, when the training data is not open source. Very few companies open source the entire thing. So I think that's something to look at. And a lot of people now want agent autonomy over everything in DeFi. And then it would follow a similar path that it did in self-driving, where you go from 1, 2, 3, 4, 5, and finally reach a level 5 economy, wherein the agent would be able to do most things.
I think we'll start at the other end this time for our last couple things, but yeah, especially what Ahmed and Wes, what y'all were saying. I think it also pivots something like to a more interesting conversation about safety, because like as we were saying, it's beating to a horse, but you can't just say that there's no need to not define what correctness is when it comes to AI agents acting on the chain, right? I mean, we've had antiviruses before, like smart contracts, where there still was a learning curve of like, what does it mean to have a user meaningfully sign? Because I mean, like the agent got rug pulled in your case because it was like a similar sounding token. So that was like something that we needed to change in the user interface or something for how people interact on chain. So is there more work to be done when it comes to defining correctness? And then also, what are the attack vectors that y'all are thinking of when it comes to bringing AI agents on, if there are any that y'all are thinking about for now?
Just pass it back. I'm down. I think yeah, I think defining the right things is super important. For example, we were having a call with Points of Parliament guys yesterday on how do you define the right things. For example, how do you define, for example, what's the what the term best, for example, is best defined in terms of attention, is best defined in terms of another quantitative thing. So I think I don't know if you can solve for it, but I think we'll reach there based on each user's actions. And what are the attack vectors? I think, as I mentioned last time, it's super important to even control the base model, so you might have to just start there.
It's almost like there's two worlds. There's certain types of inference that could be packaged into a zero knowledge proof. And in that case, I think you get a nice deterministic outcome, which is excellent. And then your attack vector is much more limited. There's also things people want to do in larger LLM models that may not be zero knowledge provable yet, and whether it's generating images or executing a trade or creating some new content, whatever you want the LLM to do. That's a difficult space, and I think like one of the approaches we're going to try to take is enabling subjective judgments on the outcomes of the LLM, such that almost like an optimistic approach, like OP Labs is taking with their rollups in some sense, where you have a certain level of truth or a certain expectation of truth. The folks that are doing the inference will have some stake in the game, and then if there's like clearly justifiable or provable, there's demonstrable evidence that the LLM was malicious or the operating LLM was malicious, that they would suffer some negative economic outcomes. So there's a couple of approaches there, but it's still an early space.
Yeah, I agree that there's differences in the definition of what is a correct output, right? I mean, the simplest attack is somebody just replaces one model that you think they're interacting with another one, so it's an incorrect output with respect to the model that you think you're interacting with. The other one would be the model has a hallucination, or the output from the model is not bounded by kind of the output that you get is not within the bounded output space that you consider reasonable for that model. And that's something that isn't outright provable. Like even with introspection, interpretability, and reasoning algorithms, as far as I know, there's no ability to deterministically prove that the model has not hallucinated and that the output that you've gotten from a model is in fact correct and factual. I would push back though on the concept that you can't prove an LLM in ZK. You can, we have work on it that's public. There's other teams that have worked on it that's public. You can prove very large language models with zero knowledge proofs. The performance right now is, not incredible, but you see these things come down by about an order of magnitude per year. I think directionally it's the correct technology for the first attack that we're talking about, which is in fact this input and this model commitment and this output correctly corresponding to each other, e.g., given this model and this input, this is the output. Yeah, I mean, it's the correct technology for that. Like, I can't see a situation where like Palantir is like using an on-chain stake weight system for like determining if surveillance systems are working properly. I do believe that we'll reach a point where they do use next generation cryptography, which could be financed with crypto as a capital formation mechanism, a la the stuff that we do with zero knowledge proofs.
Thanks. And I think as the last question to start to wrap things up, almost everything we've talked about today is like Ismael said at the beginning, it's just replacing things that we already know how to do with the AI on chain, more or less, right? It's a very easy, like, one jump. We already have a market for, like, we have a lot of retail traders, cool, let's have AI agents do that. We have research people doing that. Hey, cool, we just have an agent do that. At this moment, is there anything that you guys see coming on the horizon past just like, yeah, we just swap it out with an AI and it runs more efficiently, like any kind of meaningful quantum jump between, it's more efficient with AI, or now a person doesn't need to do it, versus, okay, this is an entirely new system defined by AI, or has like AI as some kind of cornerstone or brand new product kind of thing. Yeah, let's start.
I'll give you one anecdote that's fun. So we had an opportunity recently to build a new application at EigenLayer. It's partly for fun, partly for marketing purposes. We call it Studio. The purpose of the Studio is to mimic the use case of, if you've ever been to like a Vatsal V0 or Bolt or Replit AI, you put in a little simple prompt and it generates a nice application for you. It generates the code. Well, EigenLayer, like a lot of other crypto companies, suffers some challenges. Sometimes it's difficult to ramp up on new technology, and how do we make it easy for people to ramp up on new technology? So we use this back end to mimic that experience. So a person would say, I want to build a decentralized anything, and it would do its best to kind of build that out for them automatically. So the interesting experience there as a builder was, as you're building this application, you could either manually build parts of the code, you could write the code yourself, or you could craft the system prompt to the AI to have it do more of the work for you. And there were parts of that where you could choose either way, but I will tell you, having the AI just prompting it to do things for you is so pleasant, because even if it's not totally predictable, it makes your work so fast. You don't have to deal with debugging and all these other things. So even like from a development perspective, being able to leverage AI to do as much as possible is very tempting.
Yeah, I think we've built quite a lot of things which are similar to that. And I think AI has been not the best at coding, created testing, so you just test a ton of scenarios with it and get on with things.
I'm not sure where you guys are on that, but we had a very similar idea to do that. But we just didn't have the time. Anyway, I would just say, just generally speaking, like at least even from a DeFi perspective, just seeing yield being generated automatically feels simple as that. Because right now, you'd have to keep on searching, looking for it. So a platform or something that has vetted pools and ways to generate yield, and it does it automatically.
Yeah, I think we're a little early on adding decentralized and secure use of AI in DeFi, because I don't see any deployment of AI in DeFi that actually is very heavily used right now. I'd say that I think where it's very interesting is the application of technology built in crypto to sectors that do have imperatives of privacy and security. So a lot of where our go-to-market focuses, things like healthcare, aerospace defense, enterprise AI, etc. I think that there are natural markets that are willing to pay for the properties that are sold by the technology built in crypto, and it just requires creativity to apply it there. I think we are quite early in AI and DeFi though.
Cool. And I think that just about brings us to an hour from starting. So thanks everyone for the awesome insights. Thanks everyone for staying and listening. And yeah.
Have to do with crypto regulation. How are oranges and crypto regulation related?
Standardization of commodities? Standardization of commodities in some way?
Good guess, but no. Oranges are unfortunately the basis of how at least the previous administration tried to regulate crypto. The Howey test. Who has heard of the Howey test? Okay, the Howey test is what is used by the SEC to determine if something is a security or also called an investment contract. The Howey test was a 1946 case about oranges. So they're trying to use this case law about the sale of oranges to determine how crypto should be regulated in the States, which is obviously a stretch because blockchain technology tokens are not oranges. They're not even remotely similar, but we're still stuck with the Howey test. The Howey test has 4 prongs to determine if something is a security or not. If it is an investment of money in a common enterprise with the expectations of profits from the efforts of a promoter or third party. If something meets all 4 of these criteria, it is considered a security in the States under the Howey test. So if it fails any one of the 4 prongs, it is not a security. If you have one of these, but it's not an investment of money, then basically what you have are Uber ride credits, airline monies, because you're not investing money. You're receiving something, but it's not a security because it's not investing money. If you do not have a common enterprise, then basically you have collectible cards, baseball cards. If you do not have an expectation of profit, you basically have arcade tokens or laundry tokens. And if you do not have the efforts of a promoter or third party, you get commodity, gold, wheat, etc. So this is where crypto law gets really crazy and hard to understand. In the 2023 case, SEC versus Ripple, the court ruled that XRP was a security when sold to institutions, but the same tokens, the same fungible tokens, are not a security when they were sold on the secondary market or to retail. Can anyone have any guess why? Why is the same token a security when sold once but not twice?
Did retail not expect profit?
That's it.
The distribution mechanism, there was no promotion, direct promotion?
So both of you are exactly right. So, well, the biggest one is the efforts of the expectation of profits from the efforts of a promoter or third party. Institutional investors understood, according to the court, institutional investors understood that when they bought XRP, they are also buying Ripple's marketing. They're also buying Ripple's efforts to promote the token, to make sure that the XRP token is profitable. When retail bought it, the court decided that the retail wasn't smart enough, didn't have enough inside knowledge to understand that XRP was actually going to do these things to promote or try to increase the value of Ripple wasn't going to increase the value of XRP. Oh, I don't know why it went off. But. So the SEC has basically argued that token burning, posts describing what the smart contracts are audited, any efforts by Ripple to describe how they are supporting XRP or how they are marketing XRP is the promotion of the token of a third party. And so therefore, if the investor knew that Ripple was doing this, then to that investor, XRP was a security. If the investor did not know about burning, did not know about smart contract auditing, did not know about any of the promotion that Ripple was going to do, then it's not a security for them. So as you can see, this is very convoluted and kind of nonsensical to non-lawyers. How can you have one fungible token that is a security, while if it's sold to someone else, it's not security? This is a problem, and this is kind of what the current hopeful regulations that are looking to be passed in the States will address. The problem right now is that crypto doesn't fit into traditional financial categories. There's multiple agencies who are all vying to regulate crypto because if they are in charge of regulating crypto, then they can go to Congress and they say, hey, we're in charge of regulating crypto, give us a bigger budget. And so it's all uncertain. The SEC was established in 1934. What was the event that was the catalyst for the SEC being established?
The stock market crash.
Exactly. The SEC was established in 1934 after the stock market crash in 1929. So at its fundamental basis, the SEC is a consumer protection anti-fraud agency. The roaring 20s in America, the stock market was booming, but there was no consumer protection, there was no regulation, there was no really oversight. People were selling investment contracts in anything and everything, and because the market just kept going up and up and up, people just would buy. They didn't need any verification, they didn't need any kind of proof, no auditing, they would just buy. Stock market crashed in 1929, started the Great Depression. Then the government said, okay, this isn't sustainable. This is, obviously we need some sort of auditing, we need some consumer protection. I think it would be really interesting actually to compare the market of the 1920s in the States with the crypto market of the last 10 years. A lot of investments were made, a lot of products were introduced that don't necessarily have the greatest financial backing, the greatest data, but they were still bought because the market was hot. And then once they fell or the rug gets pulled, then people lose money. So I'm going to right now just really quickly introduce the different agencies who are in charge of regulation. The SEC, the Securities and Exchange Commission, to protect investors over the security markets. In crypto, under the previous administration, under Gary Gensler, they tried to say that every token was a security, and therefore every token must comply with the Howey test. They are an independent federal agency under the executive branch, so that means that their purview, they're under the president. The CFTC is in charge of commodities. Commodity, as you guys know, is gold, wheat, these kind of things. They're under congressional oversight. FinCEN, Financial Crimes Enforcement Network, they're more in charge of making sure AML, KYC enforcement is done. They require exchanges and custodians to register as money service businesses. So if you're building that, the OCC is the Office of the Comptroller of the Currency. They regulate banks. The FDIC, Federal Deposit Insurance Corporation, they maintain stability and public trust in banks. So every time you put money in an American bank, the bank has to have insurance through the FDIC to guarantee your deposit up to a certain amount. I think it's $250,000 right now. It used to be a lot lower when I was young, but inflation. And the IRS, the Internal Revenue Service, is all about collecting tax. So because we can't have a system where a token is a security when sold to one person, but then isn't a security when sold to another person, there's no clarity in that. It's possible for builders to keep up and know what they're doing. A couple of acts have been recently introduced into American Congress. Quickly describe what those acts are. The first one is the Genius Act, Guiding and Establishing National Innovation for Stablecoins 2025. It was passed in the Senate last month in June. I think it's right up, yeah. It's currently in front of the House Service, and according to some politicians, this will be fast-tracked to be passed by next week. If any of you have any questions about how politics work or bills are passed in the States or anything else, please ask me. I don't want this to just be a legal lecture. If you have any questions, I know not everyone here is an American, so any simple questions about how any of this works in the States are very welcome. Okay, so the Genius Act is trying to define the payment stablecoins. Stablecoins are defined as digital assets used for payments or settlements. They must be redeemable at par for fiat or treasuries, according to the Genius Act, and they're not considered securities, and they cannot pay interest or yield to holders. This one is very controversial because, as we all know, yield stablecoins are a big topic, and people are always trying to talk about yield stablecoins. If the Genius Act passes, the yield stablecoins will not be included. So if you are working on a project that is a yield stablecoin or anything, then you need to pay attention to this because yield stablecoins will not be protected under the Genius Act if it is passed as drafted currently. Genius Act requires one-to-one reserves in cash or T-bills. It must comply with the Bank Secrecy Act. It's overviewed by the OCC, the Office of Comptroller, and it's subject to audit, enforcement, and redemption obligations. So basically, they're trying to lay out.
Why would they want to include yield-bearing stablecoins, and what would it mean if you had a project that was doing one? Why would that project care if it was or was not protected by the Genius Act?
They don't want to cover yield-bearing stablecoins under the Genius Act because that could potentially raise problems with the Howey test, basically. So if it's going to not be a security under the Genius Act, then the taking away the expectation of a profit branch of the Howey test is a clear way to say that this is not security under established U.S. law. That is one of the clearest ways to denote the difference between a security. So if they allowed yield-bearing securities, then there would be a lot of conflict between the Howey test and all of the precedent that has been established over the years and the new Genius Act. And the reason why you want to be compliant with the Genius Act is because it really simplifies the rails of the registration process, the regulatory process to get approval, to be able to be licensed. Eventually, with the FDIC and the OCC, there will be stablecoin banking, custodying, and all of those things. And if you comply with this, the Genius Act, then it will be much easier for you to be integrated within the U.S. banking system.
What about if you were to lend one of these stablecoins on a DeFi platform, like Arctic, if it had yield bearing from that source, kind of yield bearing?
If the yield comes from a secondary source on the secondary market, then that is okay. So if I personally have a stablecoin and I put it on Aave and I get yield, that's fine. That's like if I own a baseball card and then I, let someone borrow it or lease it or whatever, and I make money off of that myself, then that's okay because the profit would then be coming from my efforts. The profit there does not come from the stablecoin itself, which is the last prong of the Howey test, the efforts or the promotions of the third party or the issuer. Yeah. Any other questions? So this is another big issue with the Genius Act. Who can issue stablecoins? So the easy ones, federal issuers, banks, OCC license on banks, foreign branches. If the float of the stablecoin is over $10 billion, they have to be licensed federally, which will have higher compliance standards. Potentially, these are all bills, they're not passed yet, they're still being argued, debated, and drafted. If it is a less than a $10 million float, stablecoins can actually rely solely on state regulation issuers. So each of the 50 states has their own regulatory bodies, their own regulatory, called blue sky laws, state security laws. If your stablecoin is less than $10 billion float, you can register with a state and have a lot lower barrier to entry. And this is the biggest issue. The Genius Act has language in it that is trying to stop big tech issuers from issuing their own stablecoins. And this is contentious, and if there is going to be a big change or edit to the Genius Act before it's passed, this is probably the area that it's going to be. So non-financial public companies, think Meta, Amazon, will be forced to have higher barriers of entry to issuing their own stablecoin. They must receive unanimous approval from a proposed federal review board before they'll be allowed to issue a stablecoin. And yeah, so and basically, they don't want Amazon or Meta to be able to have their own currency in America and control the supply and control the rates to it. They think big tech already has enough power. But again, this is very controversial, and if there's going to be a debate or a hang-up on stablecoins on the Genius Act, this is likely going to be it. That's the Genius Act. That covers stablecoins. At the same time, there is an act that was introduced in the House of Representatives called the Clarity Act, the Digital Asset Market Clarity Act. It's already passed in the House. The Senate hearings for it are underway and expected to be voted on with the Genius Act in the House for final passage. Real quick, does everyone understand the House of Representatives, the Senate, and the presidential signing in the States? Okay, sorry. Really basic US jurisprudence. Congress in the US has two houses. The Senate has 2 members from each state. So the senators all serve 6-year terms. So they are the more senior house. The House of Representatives is determined by population. For example, California has, I think, 55 representatives, whereas a state like North Dakota will have 1 or 2 because the population is so small. So for a bill to become a law, it has to be passed in both houses, the Senate and the House of Representatives. And they have to make sure that each house, each section of Congress has approved the exact same copy of the bill. If the bill is passed both in the House and the Senate, then it goes to the president for sign. If the president signs, the bill becomes law. If the president does not sign it, then he can do what's called a pocket veto, where basically he just doesn't sign it and then the bill never becomes law because the president doesn't sign it. Or the president can outright veto the bill and say, no, this is unacceptable. And then at that point, the bill will go back to Congress for them to work on it. Now, this is contentious and this is dangerous because oftentimes the Senate will be controlled by one party and the House of Representatives will be controlled by the other party. If that's the case, then a lot of the bills, they will not agree and be able to compromise on the final contents of the bill. They'll fight back and forth and never agree to one finalized version to pass up to the president. Right now, the Republicans control both the House and the Senate, so this is kind of a rare moment where one party has control of both, although the control is very slim and contentious, like all politics in the States right now. So the Genius Act has passed in the Senate and is now in front of the House of Representatives. The Clarity Act has passed in the House and is now in front of the Senate. So both bills are trying to find the sweet spot where both the House and the Senate can agree to the final version of the bill before being passed to Trump to be signed into law. Again, we'll see what happens.
How long do these acts tend to cost? Like, what's the average time when they think?
Very few bills ever pass. This is a very, very difficult process to get consensus from both the House and the Senate, because there's a lot of infighting between the parties in the House, there's infighting between the parties in the Senate, and then there's infighting between the House and the Senate themselves. So most bills Most bills actually never make it out of committee. So most bills never make it to actual full vote before the entire House or full vote before the entire Senate. So the fact that the Genius Act is already past the Senate and is now in the House, and the fact that the Clarity Act is past the House and is now being put before the Senate is actually relatively important progress. And it shows that there is some political will for this to be passed. So the Clarity Act tries to define what tokens or what crypto projects will be securities and what crypto projects are not securities. If the security is issued on a non-mature blockchain, if it is issued as part of an investment contract, again, under the Howey test, we're right back to this case about oranges. And if the issuer's marketing statements that suggest continued control and responsibility for success, which is very similar to the last prong of the Howey test. What's important in this is the Clarity Act, and what this is probably maybe the most important thing for builders and investors to understand about this for the Clarity Act. The definition of what a mature blockchain is. By mature blockchain, they basically mean a significantly decentralized blockchain. Under the Clarity Act, a mature blockchain is a system that has no centralized control or group ineffective control. You have to be decentralized to the point where no single person or single entity can control the consensus mechanism, can control the staking, anything like that. So open source, public accessible, broad, decentralized validator. And so yeah, centralized controls, more specifically, single party can control. Core development is not open, and economic and government powers is not concentrated. Yeah.
How does this work for layer 2?
Yeah, the token supply, tokenomics.
Okay, so if the token is distributed,
Yeah, so depending on your tokenomics, if the token is distributed, who has voting rights, who can control, whatever the protocol is given up. So your tokenomics are very important if you are establishing a layer 2. If you try to create a token that doesn't have any governing rights or something like that, then this is going to be a big issue because you're still going to be deemed as in control of the token.
and the base blockchain as well.
Yeah.
It's super centralized.
Yeah.
Do they specify how decentralized has been? Is 3 done in some way, or is that 350 or 300?
Again, these bills aren't finalized, and we'll get to this. If these bills are passed, basically there'll be a 6-month period where the SEC and the CFTC have to actually make the specific rules about what will count as decentralization, and that will be under a process where they will put out the proposal for the rules, and then they will receive comments back from industry and comments back from the public.
Just to understand, good like Solana, Bitcoin makes CX right? They would be necessarily a commodity, so it's always a contract. But base and hybrid
Yeah, I think most likely it really will depend on the final version of the bill and what they argue as. So the definition of what centralized control means is everything for them. And of course, they'll argue that they're decentralized. They'll argue that they're not, controlled by a central entity, a central party. And as in everything with America, this will lead to a lot of lawsuits. Yeah, this happens all of the time. So yeah, because the legislation will pass a bill and they'll say, we want this to be the bill, this is how we want you to rule. And then the agency will basically come along and say, that's cool and all, but we think we should rule, we should set up these guidelines. There was something called Chevron deference, which is a huge policy in the States for a long time, which basically said that if the Congress's ruling in a bill was ambiguous, then the agency gets deference. The agency can say, you know what, the Congress did not do a good job of saying it has to be 5% control. Anything above 5% control, you're out. So if there's any ambiguity, then the agency gets decide. That case was a Supreme Court case. It was overruled last year. And so now it's very unsettled about who has the actual regulatory authority, if it has to go back to Congress to be more specified, or if the regulation, or if the regulator like the SEC has the unilateral power to kind of fill in that ambiguity. But again, how this is almost always solved eventually will just be lawsuits. There'll be a lot of lawsuits about people saying, no, we're decentralized under the Clarity Act, and the SEC will say, no, you're not. And they'll go to court, they'll argue about it in front of the court will pass a ruling, that ruling will become precedent. Some courts might follow that precedent, other courts might not follow it, but there are going to be a lot of lawsuits. Any other
Have a budget.
Hmm?
So have a budget.
Exactly. So have a budget. They're all fighting for budget from Congress. The SEC is control, all of that stuff. And if you're building a project, err on the side of caution, follow all of the updates for projects similar to you, follow the court cases, and make sure that you check with lawyers. I mean, billable hours always win. Sorry to say, but having a good lawyer who you can discuss these things with and who has kept up with the recent court cases will be important. Okay, this is the safe harbor. The Clarity Act also includes a safe harbor provision that says for decentralized protocols, they will give you 3 years to get decentralized. Within this 3 years, the CFTC should come through and the SEC should come through and say, this is exactly what we want you to be ruled as decentralized. Please comply with this. But if you're not, you have 3 years to renew that. You have 3 years to fix your tokenomics. You have 3 years to get enough, to shed enough power or to get rid of the centralization of decision making before you will then be declared running afoul of the Clarity Act. Some benefits of being compliant with the Clarity Act: you get streamlined registration with the CFTC or the SEC, depending on if you're deemed a commodity or security. All right. This is where it gets difficult to project. So the House is voting on both bills. House has already passed the Clarity Act, is looking to pass its version of the Genius Act maybe within this week. Senate will have to go under a reconciliation process if the Genius Act is amended at all. So if the House comes back and they say, okay, we like your Genius Act, but we changed to this one sentence, then the House has to revote. They have to work on it all again and come to an agreement to get the bill the same. If that happens, Trump has signaled, and a lot of the Congress people, both in the House of Representatives and the Senate, have said that they hope to get both the Genius Act and the Clarity Act passed up to President Trump before the August congressional recess. So in August, Congress, both the House of Representatives and the Senate, will take a break. They'll have vacation time, basically. So it's important for them to try to get these all passed up to Trump before August. And then this is where things get a little convoluted, or more convoluted, as we talked about earlier, the rulemaking deadlines. Under the Clarity Act and the Genius Act, they'll have the SEC and the CFTC, the OCC, all of the regulators that we talked about earlier, will have 180 days to establish the new rules, to try to pinpoint and try to give the specific details of how they think that the rules should be interpreted and applied to projects. The CFTC will give 1 full year for Clarity Act implementation. So even if this gets passed up next week to Trump and Trump signs it, it still doesn't mean that it's going to be effective law next week. They have to take the 6 months to establish the rules, to establish them clearly, then to set up the infrastructure, to set up all of the framework for the rules to be applied. But the deadline is they have to be ready to actually start implementing the law and carrying the law out within 1 month. For the Genius Act, they have 18 months for full implementation. So again, if this is passed tomorrow and signed by Trump, you know, it doesn't mean that this is going to come into effect immediately. It still has a long process. The next 5 years, if these are passed, we will see a lot of stablecoin issuance, a lot of, even as we mentioned, big tech are probably going to try to issue the stablecoin. Meta is going to have its own stablecoin. Amazon's going to have its own stablecoin. They're going to try to establish payment rails and say, you know, hey, come, if you're going to shop at Walmart, use Walmart stablecoin. Why wouldn't they? The dual SEC CFT framework will be implemented, and this will be messy. Because the SEC will still fight for jurisdiction. The SEC will still fight to have power over blockchain technology and the tokens. The CFTC will also fight, again, because if they're given authority, if they're given jurisdiction, then they get bigger budgets. And politicians, people in Washington, you know, that they want the budget and they want the power and they want the respect and they want the authority to define and to control the course of development. The DeFi protocols are going to operate within defined exemptions. We're going to see a lot of probably protocols applying for the sandbox or for the 3-year grace period. So we might see a little bit more openness from the SEC and the CFTC for innovation. There's going to hopefully be clearer rules, and of course there's going to be a lot of lawsuits. This is inevitable. The final rulemaking for these things is lawsuits. It's establishing court precedents. It's one project that flirts with the line between what is yield-bearing and what's not yield-bearing. And the SEC is going to take it to court, and the court will say, okay, you know, you're a little too close to the line. And this is going to take place over the next couple of years. And kind of one of my biggest fears or my biggest areas of concern is political pushback. There is a portion of the American population who are not very happy with Trump. There's a portion of the population who are happy with Trump. If the Democrats take more seats in the midterm elections, which will be next year, we could see both the House of Representatives and the Senate, or one, flip to control from the other party. If this happens, then they might try to either pass new laws, new regulations that could upend or alter what is allowed under the Genius Act, under the Clarity Act. The biggest risk, though, is that if the Democrats win the presidential election after Trump is gone, if Trump goes, the president has the ability and the authority to appoint the chair people of the SEC and the CFTC. So if this happens, the new chair people will step in, just like Gensler was ousted and Trump's pick came in. There's going to be political pushback when Trump leaves. And this pushback might include new chairs in the SEC, which could then reflip and say, okay, we want to go completely different.
Yeah, can these bills, like the Genius Act, can they be overruled or just be completely get rid of by executive order?
That is a loaded question because executive orders have really, and that's impressive knowledge for you. Executive orders have expanded in scope over the last couple of decades, where executive orders have become way more common and way more powerful than they were used previously in American history. So some executive orders will be issued and tried to overcome some aspects of the Genius Act or the Clarity Act, and really it will depend on if the Supreme Court or the lower courts, the circuit courts, are willing to try to stop the presidential power grab.
What about algorithmic stablecoins? Do they fall into any of this?
Yeah. Whoever wrote the code will be considered the controlling party.
Even if it's decentralized after being.
Yeah. We've seen this in a couple of previous court cases where people have argued that no, this was ruled by a smart contract. I wasn't the one controlling it, and the court has basically always come back and said, you wrote the smart contract. If you wrote the smart contract and the smart contract is in control, you are in control. So that's probably, I mean, if precedents, if the courts follow previous opinions, that's very likely what the court will say.
Sorry, just to directly follow up, what about a smart contract that was obviously like written by someone but operated by a DAO or some kind of like, obviously not all smart contracts are controlled by the person who wrote them.
Yeah, that's a fair point. If the smart contract is written and then controlled by a DAO, then the DAO would be the controlling party, most likely, in the court's opinion.
What's the influence of lobbies within this process? How have they created these acts?
So basically, the Genius congressmen almost never write bills or write laws themselves. Like the Genius Act is 250 pages. There was no congressman from Oklahoma or wherever who sat down and wrote this 250-page bill. These bills are written by the lobbyists. So pro-crypto groups wrote these bills and then took it to the Congress's office and said, hey, check this out. Let's push this through. And then the congressman maybe read it, or his aides read it and summarized it for him and introduced to Congress. So that's how it happens, not only in crypto, but in almost every sphere.
You mentioned that you very similar to like how much perspective how much that is the normal stuff you influence as to for the largest saying.
I can't speculate on that, but I would say that Circle and other players that have a large lobbying budget have definitely thought about this, and that has been a consideration that the congressmen, women have taken into account. Yeah.
But like, how will they define it? Say like they stable feature, they also provide some kind of like stable staking services to the deals.
If the stable coin, I'm sure this would be a contentious area, because if the stablecoin yield is some sort of opt-in thing that's not hard-baked into the stablecoin itself, then there's a chance that the court will say, okay, that this yield isn't a fundamental part of the stablecoin, so it's not a yield-building stablecoin. But in practice, what will probably happen is even if the stablecoin issuer does have a staking protocol or some sort of yield-generating protocol, they'll run it, but they'll just run it under a different legal entity. Yeah. Oh, okay. I think I'm out of time. Thank you. If you have any questions, you can ask me. I don't know everything, but I'll try to at least answer or give you the correct framework for asking the question. Hello, welcome. This will be the RWA panel. First, I will just pass around the mics and ask each of you to introduce yourself, if that is okay.
That is okay. My name is Jaou. I'm head of growth at Morpho. Morpho is a lending protocol, second largest.
Yeah.
So, you know, man.
Hey everyone, I'm Matt, head of DeFi at Ondo. Ondo is a tokenization platform. So.
Hi everyone, my name is Jaou. I'm head of business and operations at Huma Finance, and we are a PayFi platform.
Hey, I'm Luke. I'm head of partnerships with Plume network. We're an RWA blockchain.
Okay, all right, just jump straight into the first question. The RW,
He was saying he was going to answer all of them.
Okay, well this will make it really easy if you're going to answer all of the questions. The RWA market has grown over 260% in the first half of 2025. It's surpassed $23 billion. What are the structural limits of the growth that we're seeing, especially in private credit, tokenized treasuries? Is the market nearing saturation, or do you think this is just the beginning?
I'm pretty opinionated on what assets make sense to tokenize. So
That's awesome.
On private credit, I think the limits are like really actually quite low, especially today. People talk a lot about, you know, you can take like the Apollo private credit fund and like deposit it in a DeFi and borrow stables against it. I can't answer for the life of me who wants to lend stables against private credit instead of just buying the private credit. So I think that like product market fit on that is pretty much limited to like co-marketing announcements and like the money comes from a foundation or something. Like I don't think anyone's like a stranger to that structure. And so it's hard for me to like, I think it makes sense to tokenize in order of liquidity, right? So like for T-bills, I think we're just tip of the iceberg. I think for equities, we're like even earlier. And then like as you go down the liquidity spectrum, I think that's where tokenization becomes much less appealing.
So I have a slightly different opinion on the who would lend. So who would lend against private credit versus holding the private credit? I mean, you need to be KYC to hold private credit. You need to onboard like Securitize right now. So if you want to do this, that takes like a couple of weeks. And so there's a bit of like a hurdle. While like holding USDC is convenient, and it's kind of like it's like a senior tranche of the collateral. So if you're lending, you're protected by your over. So if someone borrows with A credit or private credit, they're over collateralized. So you're protected by the over collateralization. I think there's people who want to lend cash against this type of assets, and if you think about like fintechs or whoever's very like naive and just has cash, I think it makes sense for them to have like a diversified exposure to like settle basket of equities. So in the case of Morpho, you could do this. You could have a USDC vault that's backed by various, let's say, Ondo tokenized products. It could be equities, it could be private credit. And rather than holding every single of them, if I'm giving you a diversified exposure to this, let's say 10 money markets, maybe it's an interesting experience. And speaking from, so on Morpho, you have an A credit markets, which is private credit. And a couple of fintechs actually asked us, how do we get exposed to this without holding the principal, because it's kind of like annoying to do. So maybe it will be like two types of users: the people who want the direct exposure to it, and the people who just want to be indirectly exposed to it.
Do you think like, so today I feel like the challenge is that like stable yields can be quite high in other relatively safe areas of DeFi. Like, do you think that as time goes on, there will just be like much more capital on chain, and so it'll seek out these opportunities?
I think so. I think that's maybe a good question for you, because
Let's start.
I do think like, yeah, there's so many opportunities that exist, and like this isn't like to the original question, like there's so many more things that can be done. And you saw the announcement yesterday with Robinhood, so we're seeing major institutions lean into it. And I also think part of it is just really unlocking more utility within the RWA side, right? The ecosystem that you build around it. I mean, it's not RWA, like it's not a whole chain if you're just putting it something on chain or the foundation's buying it or whatever it might be, right? And they're just holding it. There are interesting pilots where you buy it and then borrow against it, do these types of things. Morpho enable this type of usage. I think that's like the more, that's more promising bit because it enables utility that you couldn't otherwise find. Private credit itself isn't as liquid, even traditional markets, right? So it solves a need. And I think these types of opportunities will continue to grow. We'll see more of this. And I don't think it's capped at all.
I think I largely agree with what you're saying. I also think we've only scratched the surface. I think it's going to take time though. We're not there yet. As you all said, like we started with private credit and T-bill, which is like most of the market today. And private market, there was a big issue in terms of access to this asset class and also liquidity. the liquidity aspect, we haven't really solved on chain, to your point, right? Like, there's promise of secondary markets at some point, but right now, I think one of the limits, to your point of like why RWAs aren't bigger, is crypto assets as a whole. The TVL is not growing as fast as the number of new assets coming on chain, and therefore we're all kind of competing for the same capital. Where in traditional markets, you have, just an allocation of the global capital to like where you have most value, and that value is captured in the assets. I feel like we're still in a place where institutions haven't come at scale. They're going to really, I would say, create more liquidity inherently on chain and then enable a smarter allocation. But for now, I feel like because we're all competing, we're still basically like staying in a very small, like it's still a very small niche. So I think like once we have more capital coming on chain, we'll have smarter allocation, and there's no reason why RWA, which really mean non-speculative, kind of like linked to productive use of capital assets, are now going to be extremely popular. So I'm very bullish. I think it's just going to take time, and I think over time, hopefully, the same assets within traditional markets having a lot of traction should have traction on chain, with more and more, to your point, kind of like use cases of like lend and borrow on top, and secondary liquidity and all of these things. So I'm very bullish.
Do you have any opinion on what will need to happen or change to get institutional liquidity?
Yeah, I feel like the first thing is probably regulation. And you made a presentation, great presentation right earlier, I loved it, where you were explaining some of the key things in terms of market structure. Like the Genius Act is great, but when we're talking about RWA and assets, I think the Clarity Act is even more important. And so having clear sense of who the regulator is going to be, CFTC, SEC, etc. And then also knowing what is a security, what is not. All of these things are going to make institutions more comfortable. A lot of them, I mean, all of them are licensed, and they care about their licenses. And right now, for the past, I'd say 5 years, or like even 10 years, it's been way too risky to even play this market. And a few of these institutions have been very bold. I think of the Apollos of this world to kind of even play in this space, but with a lot of limits, because they have, incumbent customers that are really scared. So I feel like number one is regulation. And I would say second one, which sounds a bit soft, but it's education. I don't think that, the kinds of like great use cases that exist that the Morpho, for example, provides are known by a lot of institutional investors. They don't really know what DeFi can do. It's going to take time to educate them, but once they are educated, they're all very profit driven. I don't see why they wouldn't move.
Is bringing treasuries on chain just a wrapper, or is it a path to something that's fundamentally new?
I guess I'm the T-bill guy. Yeah, I mean, it's definitely fundamentally new, right? And it's fundamentally new in a very similar way to how stablecoins are fundamentally new. I think part of the thing that I think you voiced very accurately is we have such little capital in the crypto space. Like the TVL on chain isn't sufficient to satisfy the demand for really speculative crypto leverage, right? And so when you have Aave rates at 6%, why would I buy a T-bill at 4? Especially if I need the education to understand how this thing works and how to get liquidity on it. And so I think when we start to see either volatility up down, which it always does, every 4 years, or once we see a ton more capital come on chain in order to satisfy the demand, at that point I think the risk-free rate in crypto is much more easily attainable than it is outside of crypto, right? Where assets are interoperable, ERC20 is an ERC20. And if I think about the frictions involved buying a treasury bill myself as an American, it's really easy, kind of. It's much easier to do a swap on chain though. And so I think we're gonna start to see it permeate every level of our monetary system, especially payments.
Yeah, I was going to add, I agree 100% with what you said. I think Ondo has done a fantastic job at that. And I do think T-bills are the foundation of the capital markets globally, in the US to start with, but globally. And so again, if we believe in internet capital markets, or like capital markets coming on chain, this is the first building block. And so the fact that we've seen adoption there is really, I think is really important. And it's enabled us to play around with some of these tools without being risk on, because then you're compounding a lot of risk. You're compounding the risk of the blockchain itself, you're compounding the risk of, I'd say systemically, you're compounding a lot of, unfortunately, counterparty risk also in crypto. So like having an asset that's risk off, but that still has all of the, I'd say, technology around it, I think has been foundational for our industry. Now, hopefully we build on top of that.
Yeah, I think my point is like, when you see all these institutions lean in, the first product is usually money market fund, right? We saw this with BlackRock, we're seeing this with Fidelity, Franklin's done this, and folks like Ondo tap into those sources. I think it goes far beyond that, but I always think that this is the initial asset they're bringing because it's easy, it's not as volatile. But I think the future is like they'll bring much more assets, right? They'll bring in equities, they'll bring in bonds, wisdom trees, right? So I think there's a whole path and just starting point. Yeah.
Tokenized gold recently hit a TVL of $2 billion. Are commoditized RWAs like just the lowest hanging fruit that's left available, or will they become a core RWA moving forward?
I don't know. Good question. Can you remind us how much? We said 2 billion, and the T-bill is like 200. What was the T-bill like the T-bill on chain market cap?
Yeah, T-bill. It's grown to 23.
Okay, so it's a tenth. Okay.
Yeah.
Okay. Yeah. Okay. I mean, I think you have to look at whatever right now the market cap of gold versus the market cap of like the repo market or T-bills, and you can maybe take a direction. I don't know. I feel like there's this meme of Bitcoin being digital gold. So I wonder if like is gold on chain really something that's going to take off the same way? Like, would you rather hold Bitcoin or gold if you're on chain? If you're off chain, I think that's different. So it means if you're, and I think that's going back to your questions. What's going to come on chain? I think is how do you create net new capital and where is it coming from? If JP Morgan, you're holding it the T-bill on the JP Morgan interface and somehow this access the blockchain, I think you will have a lot of maybe gold or a lot of these assets. If it's people who are already on chain, are they going to write gold? That's very, very hard to say. So I think the discovery is going to really come from who has distribution, and that then creates like these products. So Robinhood is coming with equities. Maybe Robinhood will be the main driver of like minting on-chain equities because of that. So I think it really depends on who has users with liquidity and how do they express their like intents or preferences then on-chain. Right now it's been T-bills, but who is holding T-bill? Ethena, 10 foundations. But that's kind of like very much it. You don't have the active repo market. You don't really have like the organic liquidity that you have on traditional markets.
I think tokenized gold is super cool because in a lot of tokenized assets in the past, we've seen mostly it came from the supply side, right? So Apollo decides that they want to tokenize like a private credit fund, and then they search for like demand. Gold is like very clearly a demand-driven RWA, right? Similar to like USDT, right? And it's super interesting that like we've seen such growth in it at a time when gold has been pumping, because it shows you that like when people want to allocate to an asset, like when there is demand, they don't care if it's tokenized or not or whatever. Like crypto is just like the easiest way to get exposure to things, right? It's permissionless, it's instant. Like everybody's, I mean, not everybody, but like people in the ecosystem are familiar with the interface, and the interface is only going to get better. And so I think it's really cool to see, okay, obviously there's demand for gold. We see people going out and buying gold bars and going to Costco and like, buying the limit, melting down gold, right? And it's been this like gold rush globally, right? And there's not a lot of truly global assets other than like, crypto obviously and gold. And you can see that there was just so much demand for this thing that people didn't care about, different assets have to charge different fees, but it's like so much easier to just hold it in your crypto wallet. So this is like a very demand-driven thing, right? And T-bills have a degree of that. But I think gold is like the clearest example, like, you know, gold and stables, right? You can really see just like demand driving growth.
Thank you. I also think it's very cool. I agree with you. And maybe building on your earlier point, where Bitcoin is a reserve currency today, and I'd say maybe associated with the digital world or the digital economy, where gold is a traditional reserve that was, you know, invented way before we had a digital economy. And I get excited when I think about the creativity of DeFi and how when gold becomes tokenized, the kind of like synthetic assets we can build, where you can get, you know, exposed to both gold and Bitcoin, if Bitcoin becomes really the digital asset currency that is a store for a reserve currency, I think we could like be so creative. And I also think that tokenizing gold, to your point in terms of access, is showing that the success of the tokenization of gold is showing that even though, yes, you had access, there were ETFs, there were other things, people didn't feel that it was really accessible to them. And I think that the perception of crypto being really on your wallet, I've been around in Cannes this past few days, and every single cab driver I've had, knowing that I was going to the crypto conference, is asking me, what should I buy? So I think there is a big mindset shift in like people's ability to get exposure. So gold was available before, but now it being tokenized, a lot more people are going to think, well, I want to get exposure to it. So I also think that's very exciting.
I think one of the coolest things, like one of the most used ETFs was like one of the most used leveraged ETFs is the gold ETF. Right? People love to buy that. There's like a double, there's a triple one. I'd love to see like a gold loop on chain using Morpho to be able to leverage into a gold asset and purchase that. People want that exposure. Clearly, it's been very popular in this climate. You know, it's safe, I get it, and yeah, bringing in something like that on chain would be tremendous.
Are there RWA asset classes that you feel may offer truly unique tokenization value?
Well, okay, so obviously, like, to your point, access, right, is like the thing, and most assets gain some access benefit from being on chain, right? So I like, it's hard to call it a specific asset class that's like most representative for, but there's, you know, think of an asset, right? The stuff that I think is like gonna wind up being really interesting in the next few years is like assets that don't change hands, that have demand. So, you know, private company shares, I think that's gonna be really cool. We're not really working on it at Ondo, like, you know, we're going in order of liquidity, but that's like truly a new market, and it had, like, the key thing that differentiates it from illiquid private credit in my mind is that the audience is more interested in buying it, right? So like, people that are like accustomed to crypto are interested in buying SpaceX shares, right? It's like it's innovative, it's tech-based, whatever. You know, OpenAI secondary shares, I'm sure, would be like a very popular product, right? I don't know if like people care as much about like you know, like mid to high yield, like 12% APY, like corporate debt product, right? But you know, the audience that's like alive in crypto today and like drawn toward it first is like the tech-enabled, you know, innovative thinker, and so I think those sorts of things are like especially interesting in crypto, where like that market just doesn't exist on off-chain.
I love that point. I would add also another, I don't know if I could call it asset class, but type of assets that will exist on chain and are RWAs, those where the actual productive economic activity happens on chain. And that's only starting now. I think with mostly tokenized assets where the underlying assets or the underlying value that's being created is created somewhere in the what we call real world and has nothing to do with on-chain activity. What we focus on at Huma is PayFi, but where the payments are actually happening on chain. So now we've had, I think one of the first real product market fits in crypto where stablecoins are being adopted by payment companies that have nothing to do with the blockchain and at scale from the perspective of what we've seen before for Web2 companies. And so now more and more value is going to be created on chain. Profits are going to be made on chain. How does that value get captured? And more that can be captured on chain as well, distributed on chain as well. And so I get very excited about that. I find it to be like a very fertile space for also innovation and creativity.
Yeah. I think just to the point of like truly unique, things like I would say private credit is liquid, right? You mentioned that, so maybe like that, something the liquidity behind it. I also think like emerging markets, getting access to like equities and ETFs are not as easy, right? You probably have to go through more hoops than you would have in the US. So seeing that take shape is definitely another, I think, unlock for folks.
30 seconds on something I just thought. Maybe like identity is something that's a reward asset. So if you think about, okay, there's products which are yield generating, but most people borrow in a bank right now under collateral. And the reason they can do that is like they show 3 months of salary and people say, okay, like you look fine, I'm going to issue credit against you. What if you could have a reward asset, which is effectively an extension of you or your identity or your wallet? Like notion of wallet today is just coins, but like what if it's a bit more enhanced than this? And could you have a representation? Maybe it will be fungible, maybe infungible, maybe that's a question we can discuss later. But like, I think something that represents your capacity to borrow effectively would be an interesting collateral, and even something you can use to do various things.
There are projects looking to tokenize luxury watches, wine collections, commercial aircraft, renewable energy infrastructure. Are there type of assets that aren't necessarily a good fit for tokenization, or is this just a matter of time? Is this a waiting game before every market is brought on chain?
It depends on what you do with it. If you want a single market, it's hard. If you just want to buy a watch and prove that you're the owner of this watch and transfer it twice in your lifetime, I think it's fine. So I think it really depends on like, do you want to trade this or do you want to take some sort of leverage? Do you need a notion of price right now, right here? If not, it's like a house, you know? I think it's fine to have an illiquid house until you have a buyer. But if you can send the ownership of a house to someone, it's actually quite powerful. So it depends on the use case.
Yeah, I mean, I think we tend to see a lot of these like luxury watch, tokenizing wine, tokenizing whiskey things coming from people who just have this like underlying love of like the underlying asset. And I think to the degree that they're finding tokenization to be helpful for them, it's like great. But I think you have to have that passion about it, or else like the opportunity size is just like too niche. So I think we'll continue to see that sort of thing like pop up every cycle. But it's it's not something that's gonna like you're not gonna scale the demand for luxury cars, right, by like fractionalizing them on blockchain. But it might be a great place for like car lovers to come together and like trade hands or borrow each other's car or whatever.
Yeah, I think the blockchain or Web3 generally is really good at communities or creating communities and kind of like giving them a way to coordinate. And so to your exact point, I do think that like fans or like communities that love a specific product can find in the blockchain a great way to collaborate globally, which is very helpful. But then I also think that, some of these assets are just really niche. They're collectibles. They're already illiquid in, traditional markets. Bringing them on chain is not going to de facto make them liquid. And then if we go back to the fact that we're all competing for the same pool of capital, you make that even harder. So I think that I'm more bullish on community dynamics around some of these assets when there is a fan base, to your point, than on the idea of bringing them on chain to make them liquid.
Yeah, I have a much more like markets-based approach on this. I just feel like those assets haven't done well because they haven't been, like, watches did really well during COVID, right? Everyone was buying watches, but then since then they had a huge decline and they kind of just went down, right? Collectibles, I think, follow that broader trend as well. But the idea is like, if you have all of them, when the time comes and they spike, then people naturally buy. You'll see a lot of folks having that appetite. But right now in this lull, maybe that doesn't do as well. Gold also was a terrible asset for like, I think 5 years, didn't do anything. And then all of a sudden this last year it's doubled and even more, right? So I think like when you want the assets there, And then when the time comes, just speculation, whatever it may be, some macro trend that's pushing it, you'll see a ton of appetite. And that's, I think, the whole point of getting the assets on the chain first, so that people can express their feelings. So that, I think a lot of crypto people are here to make money, right? They're here to trade and express their viewpoints. You know, sometimes you're right, sometimes you're wrong. But I think it's important to get all the assets so they can do that.
Why haven't we seen a lot of popularity with synthetic tokenized assets like synthetic equities or synthetic bonds? Back to something like USDC, where institutions can access it without having to hold the underlying on their balance sheet.
There's a little bit of path dependency, right, from a regulatory side. You know, like, you might actually be the right person to answer this part of it, but like, beyond that, beyond everybody being worried, right, like one of the conversations I have the most these days is around perps on RWAs. And, you know, the first problem is getting an Oracle price, right? So, you know, for equities, it's relatively straightforward, 24 hours a day, 5 days a week. But over the weekend, it's like, well, what do you do, right? And people don't really want to close their perps out over the weekend. Perps platforms don't want to close people's positions out over the weekend. Because if you're not in profit on your perps position, then you're getting your collateral closed out. But like, maybe you weren't wrong, you were just early, right? And so if you have to like get your position closed out over the weekend, because there's no Oracle price update, then like you lose like your capital, right? So that's one huge challenge. And yeah, like it's gonna take years before we get enough secondary market liquidity, in my opinion, for like weekend perps on equities to work. But I think we'll start to see it with, I mean, you can already see like, you know, indices that trade, you know, with better, you know, global market hours or, you know, gold or oil or what have you. Like, we'll start to get like perps on like the CFDs for these things, I think. And then, you know, the other challenge is liquidity, right? And so what we really need to do as a space is build more perps protocols that or margin protocols, whatever, that utilize the underlying, like in a tokenized format, so that you can collect funding on the short side at the very least. Because otherwise, like, imagine you're like a market maker trying to like make, you know, tokenized Tesla, but it's not tokenized, it's just synthetic Tesla, right? You have to fully fund every order in the order book, right? You have to have that USDC on hand. And if you're the type of entity that's good at this, you know, making markets on Tesla, it's much cheaper for you to make those markets off-chain because you don't have to put up all the capital up front. And so I think this like fully funded notion is quite difficult, whereas you could bootstrap it like Athena style, where somebody deposits like a tokenized Tesla share and then shorts the perp against it, or you could even tokenize a short position and long the perp against it. I think we're gonna need those sorts of ingredients before we manage to like see a lot of perps, but they are coming.
You kind of touched on this. Can RWA tokenization make illiquid assets actually liquid just by bringing them on chain? And if so, or if an illiquid asset is tokenized, what is the best approach to pricing the illiquid asset?
Who do I pass the mic? I feel like.
Can you repeat the question once more?
Yeah. Does RWA tokenization make an illiquid asset liquid? And if you have an illiquid asset that you tokenize, how do you price it? Do you oracle it? NAV attestations? What's the approach?
So I think right now,
yeah,
anything that needs to be liquidated or sold needs like some sort of real world like activation or a path to liquidation. You can, in the case of lending, in the case of other things, you can have a fixed oracle, or you can have something much variable and someone reports dispute. It can be a NAV from Apollo, it can be Chainlink, it can be like you name it. So you could set up an oracle that responds to something which is completely blank that you choose. Today, if you want to liquidate something which is not liquid, you need to find a path which is usually centralized, because the on-chain is the small part and the kind of off-chain is the bigger one. yeah, in that regard, I feel like you need this. It's kind of like nothing is looking natively on chain if you need to exit it because it's called reward asset because it's coming natively from there.
I just want to give a quick shout out to Morpho, right? Because it's really revolutionary to be able to price that illiquidity, right? And so, like, let's say, you know, there isn't like clear on-chain liquidity for one of these RWAs, but there's probably a buyer at some price. As the lender, I can make sure that I'm getting paid for taking that liquidity risk, right? And that's like only unlocked by like the flexibility of a Morpho style design. And so I think it's like a really important ingredient for that. That's why I handed you the microphone.
Yeah, I second that shout out. I think that having an ability to price liquidity is really important. Then the problem is that price might be too high and it becomes cost prohibitive to even leverage it. So I think we go back to the earlier point of if it's really liquid, no matter what, then maybe that's not the right tools. And I don't think by virtue of going on chain, you just create that liquidity. The data that goes into the NAV feed has to come from somewhere. There is no record of any transaction that like the gap or like the gap might just be too big. But I do think that secondary liquidity is an interesting concept on chain as well. Not many markets exist, I think, for now. But I do think that secondary liquidity in traditional market is not very good. And so I'm excited to see more of that happening for all sorts of assets.
Yeah, I think it's hard to solve the liquidity problem, but at the end of the day, someone should be willing to step in to purchase something at a discount. You know, whether it be 10%, 5%, something like that. With private credit, it's pretty clear, like it goes to a redemption period and you do get yields back. So it's like kind of easier to spec it out, like, oh, this is the discount I need to purchase it. Some things it's harder, but some things are super liquid on chain, right? So, or sorry, in traditional markets. So we will do that. But yeah, I think definitely more liquidity is needed to like make sure all this works on chain.
Any other questions? All right, I think that's it, Chris. Thank you so much for your time. Any closing remarks? You want to pitch anything?
Buy a fart coin.
Thank you so much.